2 of the AAT Practice Assessment 1. Okay, so task 2A.1 says identify which one of the following should not be included in the valuation of inventory at cost. It's only 1 mark, so don't spend hours on it. Okay, but we do know that inventory has to be valued at the cost it costs us to buy them, bring it in, and the cost of purchase of ingredients, we know we've got to put that into the cost. Carriage inwards of the ingredients, that's the ingredients we're paying for the carriage to get it to us. Labour costs to cook the cakes, yep, we need to put that in because that's one of our prime costs. So those 3 items make up our prime cost to be able to calculate the cost of the production of the unit. So the 4th one, refrigeration costs for the storage of the cakes, is not classed as part of the inventory. Okay, it's not a traceable expense. It doesn't relate to the actual physical product itself. It's just storage to keep them cool. So the refrigeration costs don't get added to the inventory cost. Then we're on to the lovely accruals that everybody seems to dislike. Okay, so the easiest way to think of an accrual is you're adding it to something. Okay, so if it's an accrual of rent that we're paying, you're adding it to it, you're increasing the expense. Okay, if it was rent received, you're increasing the amount that's owed to you, the amount that you should have received. Okay. So this is saying an accrual should have been made for rent. So if it just says rent, you're assuming that it's an expense, okay? So, assets. Would it affect the assets? No, it wouldn't, because if we're paying rent, we don't own the buildings, okay? And the buildings would come in as a non-current asset. So assets are what the business owns or is owed, such as trade receivables, if they've got money in the bank, petty cash, motor vehicles, and so on. Okay, so there's no effect. Profit. Well, rent is an expense, and the rent account is recorded in the statement of profit or loss. Okay, so yes, it will affect the profit. Okay, and if we don't accrue the rent, so we don't add to it what we've already paid, it would overstate the profit for the year. Okay, so the net profit. Moving on from that then, you've now got the following information relating to rental income. This bit's really important, rental income, and the year ended is the 31st of March 2018, or whatever date. On the 31st of March 2017, an entry of £1,000 was made into the rental income account in relation to accrued income. Income. It's not expenses, okay? So when we account for income, it always goes on the credit side, okay? So what we've said here is that last year, we was owed an additional £1,000 of rental income. So we would have added it to the amount that we got, which were in the credit side. So the first thing you need to do now is realise that the £1,000 has to be reversed, okay? And so it's got to be on the opposite side. So it's accrued income reversal. Okay, so if you do it as you go along, you're not going to, panic yourself and you've not got too much to think about. Then it says here, cash book entries for the current year relating to the rental income are £12,000. So that means we've received £12,000. So if we receive money, we debit the cash book, debit the bank account, okay? So what we've got to do is we've got to credit the rental income account, and we would put in cash book as the detail, because that's where the double entry would have been. Okay. And it says here, this included a receipt of $4,500 which related to the 6 months ended 31st of July. So don't forget, our year end is the 31st of March. So you've got April, May, June, July. You've got 4 months that can't be accounted for in this figure because it relates to next year. So if you did 4,500 divide by 6 gives you 750, times it by 4, which is your 4 months, you've got £3,000 of that relates to next year. So what we've got to do is we've got to take it out of the income account, and this would be prepaid income for the next year. So you would have credited your prepayment account, okay, because this is money that it can't go through the business yet because it relates to next year's accounts. Okay, you can see then that the accounts don't balance, so the difference between the highest side and the lowest side is £8,000. Okay, now this is where you've got to remember where to send it to. So it's going to go to one of your financial statements. Okay, so it'll go to, we should have a statement of profit or loss. Okay, so we're transferring it to the financial statements so that we can calculate our profit, which means then we can move on and calculate what tax we owe, etc. Okay, so quite easy when you pull out the information. So there's a lot of words there, but you're only pulling out the important bits, how much and what it's actually for, and the dates. Okay. Then it says the balance on the receivables ledger control at the 31st of March 2018 is $27,468. It is company policy to adjust the allowance for doubtful receivables to 2% of the total receivables. The company has only one general ledger account which contains specific and general allowances for doubtful receivables. The allowance for doubtful receivables on 1st of April 2017 was $558.27. Okay. At the end of the year, Alice asks you to make an allowance for a specific doubtful receivable of $2,380, which she felt was not likely to be paid. There was no specific allowance in the previous year. Okay, so basically what we're saying here is that they feel that $2,380 is not going to be paid. Okay, so that's going to be a bad debt. It's going to be a specific bad debt. Okay, then what we've got to do is we've got to work out what we've got to do regarding the provision. Okay, so remember to calculate the provision. Yeah, you start with your total receivable, take off the bad debt, the one that we think or we are most certain not going to receive. Okay, so 27468 minus 2380 gives you 25088, and they want to make a provision of 2%. Okay, so times that by 2% and you get £501.76. Okay, we've actually got a provision in at the minute for £558.27. Okay, that means we've got a difference of £56.51. So we need to reduce this doubtful debt provision by £56.51. Okay, so we'll first deal with the allowance for doubtful receivable that we feel we're not going to get. Okay, so we've got allowance for doubtful receivable. Okay, which we feel is going to be a credit of 2380, and it's going to be an adjustment, which is a debit of 2380, because that's going to be an expense to us. So what we're saying is that we're going to put an expense in because we feel we're not going to receive this, and then we'll credit the allowance for doubtful receivable, which would be credited in the statement of financial position, and this one would be entered in the statement of profit or loss. Okay, then we're going to deal with the additional bits. Okay, because it's been reduced by £56.51, we need to do an allowance. So I'm going to do allowance for receivables adjustment first, because I need to reduce it by £56.51. Okay, which means then that my allowance for doubtful receivables in my statement of financial position will increase by £56.51. Okay, so what we're saying here is I had 558.27 as my provision, which would have been credited in the statement of financial position, and because I need to reduce that, I need to debit my allowance for doubtful receivables, which would be in the statement of financial position, and I need to credit the adjustment account so that it reduces the general provision. Okay, so we're keeping these because this is, we think, is going to be a specific one. So we've entered them separate, so we know that this is the one that we think we're not going to get paid for, and this is the adjustment we need to make. Okay, so that's the end of that task. Okay, and again, 14 marks. If you read it carefully and work through it step by step, it's quite simple. Don't let the words on the screen bog you down. Okay, once you're done, submit your answer. Okay, so that's task 2 completed.